This is Simrat Singh from Vinod Kothari Consultants. Today, I'll be discussing about the monetary policy and how does it affect the lending sector in India. I'll also be talking about various macroeconomic factors and how they affect the lending sector. So let me quickly share my screen. Budget, Bazaars and Bank Rate, that's the title. So basically, this will be the outline of the small discussion. I'll be talking about how RBI and the government, they control the Indian economy and what all steps they take and what are their implications for the banks and for the NBFCs, etc. Now, the first question is macroeconomics. How is it relevant for us? So, as someone who is working in the financial sector, or let's say for a financial sector entity, we have to understand that all the regulations that are being made, they ultimately have certain background to themselves. For example, let's say there's any target that the regulator wants to achieve, or let's say there's any structural issue in the economy. So all those targets or all those issues that are happening in the market, ultimately they form the basis for the regulations. So here I have depicted that there's some market factors going on, or there's something in the economy that's going on, and ultimately they find themselves in the regulation. So as someone who's working in the financial sector entity, or as for the compliance officers of the financial sector entity, it's become important to understand what is happening in the larger macroeconomic factor. For example, recently there was a stress in the microfinance sector. So what RBI did, it relaxed the qualifying asset criteria. Similarly, SEBI, it comes up with numerous RBT circulars time and again. So at one hand, we want to improve India on the ease of doing business, but on the other hand, we see the market and we see various entities, they bring up some devices to siphon the funds. So because of that, whatever happens in the market, SEBI or the RBI, they take into account it and then they make the regulation or they bring any amendment in the regulations. So if we understand what is happening in the larger macroeconomic landscape, we'll be able to interpret these in a better manner. So moving on. Firstly, brief discussion on how banks work. So this is a typical balance sheet of a bank. So on the one hand, you have liabilities, and on the one hand, you have assets. So you have current accounts, savings accounts. The bank also have some assets. Majorly are the loans, but it also has other assets. For example, let's say it has invested into government securities, and there are certain central bank reserves as well. Now, bank is basically in the business of borrowing money to lend money. Whatever it is, what's the interest rate that is giving on the deposits, that is its costs, and whatever interest it is charging from the loans given is its income. Now, what are the factors that a bank considers while determining the interest rate? So, firstly, you have your desired spread or the desired net interest margin. If you want a higher profitability, you will certainly charge more. Or let's say, what's your liquidity position? If you have a surplus cash with you, you will be able to lend at a lower rate. Or what is your cost of operations? If you have a lot of cost of operation, if you are a big bank, if you have a lot of ground level branches, your cost of funds will increase, your operations cost will increase. Next, we have credit worthiness of borrower. How risky is the loan? If it's a very risky loan, you'll price it up. And then if it's a floating rate loan or a fixed rate loan, so this is connected to the tenure of the loan. If it's a long tenure loan, the bank would like to pass on the interest rate risk, because कल को अगर मेरे खुद के जो costs थे अगर वो बढ़ गए, then I should be as a bank, I should be in a position to pass on that to the borrower. So in India, around 75% of all the gross advances are in the nature of floating rate loans, and around 24% are in fixed rate. And then one of the factors that banks consider is the repo rate. Now, what is the repo rate? We'll just come to in a bit. Coming to NBFCs function in the same manner, except they do not accept demand deposits. So the green part that you see on this liabilities, this will not be in the NBFCs. Rather, they will have more borrowing. So NBFCs, they basically borrow a lot from banks and then they lend to retail or other persons. Moving forward, so coming to repo rate, that is the primary tool of RBI to control the interest rates that the banks are offering. So before coming to repo rate, the question is why does RBI wants to control interest rates that banks are offering? Now, this stems from the fact that objectives of RBI, they have a certain conflicting nature. So here you can see it has dual objectives. But on the one hand, it wants prices to be stable. On the other hand, it wants the GDP to grow or the economy to grow. Now, both of them are contradictory in nature because if you focus too much on growth, or let's say you generate too much demand, what will happen? The prices they may not be the same. You might have inflation. So if you let's say if you reduce the interest rates, what will happen? It will become very cheap to borrow money. So if you are able to borrow cheaply, you will be able to have a lot of liquidity and you will generate a lot of demand. You'll go ahead and spend. You will generate a demand. So that will give the sense to the suppliers that there is demand. Let's increase our supplies. So there will be economic growth. However, if the interest rates are low for a very sustained period of time, you might get inflation because you have increased the demand by making it cheap to borrow, but the supplies they may not be able to cover up as fast as you have increased the demand. So then you will get inflation. Now in a country like India, some inflation is good. So currently we're targeting around 4% inflation, but there's a tolerance of plus minus 2%. Basically 2 to 6% is our inflationary target. So this is why RBI wants to control interest rate because it has objectives which are very much dependent on the interest rates. Now coming to repo rate. So before delving into what is repo rate, there's certain background. So banks, they have to maintain certain cash reserve ratio, CRR, with the RBI in form of cash. And it has to maintain SLR, statutory liquidity ratio, with itself. So for this discussion, what is relevant is CRR. Now banks, they have to maintain CRR with the RBI, and it is calculated on the NDTL, net demand and time liabilities, basically all the deposits that the bank has. Now, the base is the deposit and you calculate CRR on the base. However, since the banks, they form part of the payment and settlement system, they also accept demand deposits. So it's very likely that your days, that is the deposits, they change on a daily basis. So let's say today you had to maintain 3 rupees with the RBI due to your underlying deposit base. Tomorrow your base changes. Some people withdrew money, some people deposited money. So now tomorrow you have to maintain from 3 to you have to maintain 4 rupees. Now, day after tomorrow, again, let's say there will be some withdrawals or there will be some payments being made. Again, you have to maintain 3 rupees. So for just one day, from 3 rupees to 4 rupees, and then again back to 3 rupees. So for just one day, the bank, it had a deficit of 1 rupee because it had to maintain it with the RBI. Now, similarly, there are many other banks in the economy. So it might so happen कि एक bank के पास deficit है and some other bank might have a surplus for one day. So what will happen? The deficit bank, it will call the bank which has the surplus. It will call and it will say कि, do you have surplus? Will you be able to lend it to me for just one day for overnight basis? So if the other bank, it has the surplus, it will lend it on an overnight basis, and the rate at which the bank will lend, it will known as the call money rate or the weighted average call money rate, WACR. Now WACR is a short-term rate and it depends on a lot of factors like what is the liquidity in the economy, what is the liquidity with the banks, how much is the demand for giving loans, etc. Now this WACR, it is the operational target of RBI. So what RBI does, RBI monitors this WACR and it wants to keep it below the repo rate. So repo rate now comes into picture. Repo rate basically acts as a sort of a ceiling for this WACR. Now, in technical terms, repo rate is the rate at which RBI lends money to banks. However, we have to understand that there are two systems parallelly going on. One is what is happening in the market. Banks are lending amongst each other, and what is happening in the let's say the official channel or the channel with the RBI. So RBI can control this part. It can set a target for this. However, the WACR is dependent on the market forces. What is the liquidity in the economy, etc. Now, what RBI does, it monitors this WACR and it sometimes injects liquidity or sometimes it's let's say it sucks out liquidity. And now why does it do so? So that the WACR hovers around the repo rate. For example, let's say if there's too much, if the WACR has risen a lot, if the WACR has moved beyond repo rate, now that means the overnight lending has become very expensive. So what the RBI will do, RBI will then inject liquidity so that there's surplus of money and the lending rates they can again come down. So here you can see very recently around 22nd July, the WACR it moved above the repo rate. So what RBI did, it conducted repo rate auctions to inject liquidity for a short term. So again, repo rate, as I said, is the rate at which RBI lends money. So here you can see the yellow line, it is the repo rate. The overnight lending rate of banks, it stays below this, because as soon as RBI sees ki, it's moving towards the repo rate or it's going above repo rate, RBI will then use its tools of monetary policy, like CRR, SLR, open market operations, VRR auctions, etc., to again influence the weighted average call rate in such a manner that it stays below the repo rate. We'll come to it. How does it do so? Now, one question is, all these rates, WACR, or let's say, the repo rate, all of these rates, they are overnight in nature. So how do they affect the long-term rate? So let's say if I go and take a home loan, it's of let's say 10 years, 12 years. But this repo rate, it is only for overnight lending. So how does the RBI ensures that if today I change my repo rate, the bank will also necessarily change its loan rates as well? So this is the concept of transmission of monetary policy or transmission of repo rate. So there are a few reasons why this transmission occurs. So first is that repo rate, it acts as a base for short-term rates, and your short-term rates, they in turn acts as a base for your long-term rate. So if you influence the repo rate, again T-bills or let's say commercial papers, they will become more expensive if you increase the repo rate. Now every the marginal cost of funds will also increase for the bank. Now this kind of acts as a base for your long-term rates as well. Now, the next reason, which is very important, is the benchmarking, or right now we follow external benchmarking. So as I said, 75% of all gross advances in India are floating rate loans. So the banks, what they do is they peg the interest to something external, or the RBI has told them to peg the interest to something external. So basically what happens in a floating rate loan is that the bank will not say ki, I will charge you 13% for the tenure of the loan. But what the bank says that I will charge you some rate. It can be, it can be the repo rate, it can be the external benchmarking rate, it can be some benchmarking rate plus 2 or 3%. So whenever the benchmarking rate changes, the total interest automatically changes because you are calculating it over and above the benchmarking rate. So in India, we have transitioned from prime lending rate PLR to marginal cost of fund based lending rate MCLR, and now currently we are in ABLR. So PLR and MCLR, they were somewhat internal to the banks. They were dependent on a bank's own operations. EBLR to a large extent is based on something external, some external rate, like for example, repo rate. That is why the word external benchmarking. So now EBLR is also different for different banks. So for example, EBLR, what happens in the EBLR is you take a base, let's say you take repo rate as a base, you add a lot of components, like you add your cost of operations, you add your desired profitability, etc. And then you come out with the benchmarking rate. Now, EBLR can be different for different banks. Now, on this EBLR, you calculate your spread. So when the repo rate changes, it is certain that the EBLR will also change. The change might not be in the same proportion, but the change will be there and it will be in the same direction. For most part, it will be in the same direction. So, however, one thing is that when you change the repo rate, the immediate change may not reflect in the loan rates. It might it will transition, but it will transition after some time. Let's say 3 months or let's say 4 months when the reset happens. So that is one reason how you can change the repo rate to change your ultimate, the loans that you have given to the borrower. Then there's this economic concept called expectations hypothesis. Basically, it is again this concept that your short-term rates, they determine your long-term rates. Here I have put a graph like after COVID, the RBI reduced the repo rate, and then you see a reduction in the average bank lending rates in India as well. So the reduction happened, however, it was not immediate, but it did happen. So this is a proof that transmission does happen of monetary policy. So let's take an increase in repo rate. What will happen? So you have increased the repo rates. What will happen to the banking sector? So if you increase the repo rate, the loans, the banks will be now charging more money from the borrowers. So what will happen? The net interest margins for a short period of time, the banks, they will enjoy larger net interest margin. Their spread will increase because the interest that you are paying on your deposits, that is somewhat certain. You have taken a fixed deposit for 3 years. You know, okay, for 3 years I'll be getting 10% or let's say 12%. But the loans are floating rate. So as soon as interest rates have risen, your loans, the loans, they will also be more expensive. So the bank, they will now enjoy a higher net interest margin. Now this will be for a short term. Why? Because over time, your depositors, they will come to you and ask for a better interest rate, because the general interest rate have risen. So the depositors will tell you ki you are giving me so and so percent interest rate, but other instruments in the economy, they are yielding me better interest rate. So at one point, you will have to reprice your borrowings as well. And when you will do so, the thing that you were enjoying, the short increase in your net interest margin, that will come down. Similarly, vice versa, if the interest rates will fall down, there you will see a compression in the net interest margins. Stock price of banks may rise if there's an interest rate rise in the economy. That is an exception as compared to stock prices in general, because in general, if you increase the interest rates, the borrowers, they will now borrow at a higher price, so they will not borrow as much, and consequently they may not have enough liquidity, and they might not generate enough demand. So the products of companies, they may not be sold. So stock price of a bank, however, on the other hand, may rise because they will now enjoy a better net interest margin for a short time. Moving on, coming to another important concept, that is liquidity. How is liquidity connected with interest rates? So liquidity is basically the supply of money in the economy, how much money is going around the country, or how much money is going around with banks. So if we apply the concept of demand and supply, so supply is basically the liquidity and demand is how much people want to borrow. So if you increase the liquidity, if you increase the supply, what will happen to price? The price will fall. That is, the interest rates will fall. So if you want to control interest rate, one thing that can come in handy is if you can control liquidity, and that is what RBI does. Now, liquidity, there can be deficit or surplus, there can be mismatches in the economy, and they can be long term or short term in nature. Now, what I mean by that is, so coming to the example of short term liquidity shortfall. So let's say when you are paying tax, when it's the tax season in, let's say, July. So what will happen? The money from your bank, that will be deducted, and it will be credited with the government's account with the RBI. So what is the net result? The liquidity that was in the economy, that the deposits that were with the banks, they will be reduced, and the government's money with the RBI, that will increase. Now, this is a short-term deficit of liquidity. Why? Because over the course of time, the government will again spend it back on the economy, on the people, on the citizens, etc. Long-term liquidity, how can that will be affected? So, for example, let's say there's a foreign investor. It has invested funds, it has invested in securities in India. Now, let's say it sells their Indian investments. What will happen? It will have liquidity, it will have rupees with itself. But when it wants to go back to its country, let's say US, now what will it do? It will go to the RBI, it will exchange its rupees for dollars. So the investor will have dollars with itself, and then it will go back to his country. Now, what is the net effect? The rupees that were circulating in the economy, they have went to the RBI. Now, this is a long-term deficit, because RBI will not directly spend it on the economy like the government will do. So just a concept to keep in mind, it will be relevant in other slides. So coming to what RBI does in case there is an liquidity mismatch. So here coming to the first one, that is fine tuning operation. So I want everyone to imagine a screwdriver. So what happens in a screwdriver? It is a very precise instrument. Okay, you can control the exact amount of pressure you want. You can control the exact, it's a very fine instrument. You can control it very precisely. So there are certain instruments that RBI uses that are similar nature. For example, variable repo rate auction. So what happens is RBI, it conducts these repo auction, as you can see in the news also. So it conducts these auctions to inject very short-term liquidity of, let's say, 7 days or 14 days in nature, or overnight liquidity. Now, on the other hand, when there's let's say, a sustained period of deficit, in this slide that I've shown, if there's a long-term liquidity shortfall, you will not need a screwdriver. You will need something more permanent, or let's say something which has a more force, that is permanent nature. You would want to use a hammer. So what is the hammer's equivalent for the RBI? It is open market operations, or OMOs. So basically what RBI does, it purchases or it sells government securities in the market. So banks, as I said, they have their investments, a lot of their investments in government securities. So what RBI will do, RBI will purchase these securities and it will give the money to the banks. Now banks have their money, they can again go ahead with the credit creation, etc. And this injection of liquidity, it is not immediately reversible, as is the case of repo rate auction, because then in repo rate auctions, you are reversing after 7 days or 14 days or let's say 8 days. But this open market operation, this is of a somewhat permanent nature. So this is how RBI fights the liquidity mismatches. This is also how RBI monitors the WACR and influences the WACR. Moving on, so these were the quantitative tools: CRR, SLR, your VRR, etc. You are controlling the quantity of credit that is going on, or you're controlling the quantity of liquidity. Now, if you want to control the quality, so for example, if you want more money to flow into, let's say, agricultural sector, what you can do, you can use some of these tools. So, for example, priority sector lending, PSL. So what RBI did, it gave certain targets to bank key out of your total advances, some portion should be in these sectors. So you are controlling the flow of, let's say, the liquidity. Then there are other requirements as well, like margin requirement, basically to make banks. Margin requirements are basically there to ensure that banks, they are not lending on speculative businesses, and the LTV value is somewhat sustained. Then there's also direct action. So RBI, if it sees that there's some mishappening that's happening, or there's some non-compliances, RBI can take direct action. Then you have moral suasion as well. Basically, this is related to what the RBI governors gives in its speeches or any press release that happens. So it is basically for banks somewhat like they are taking the informal request of RBI as formal. Now, in what cases will it work more is when RBI tells informally to banks not to do something. For example, it tells banks, let's say, for example, to not lend for speculative businesses. Now, this is an informal request. However, it might have an effect of formal request, because banks will inherently will be able to would want to follow this request. Now, this moral suasion, there are other tools as well. Moving on. So these are the monetary policy stances of RBI. So let's say if you want your economy to grow, so what you'll do, you want to generate more demand. So RBI will lower the interest rates to to boost liquidity, because people will be able to borrow at a cheap price. You will generate more demand. You will generate a lot of supplies, and your GDP, it will increase. On the other hand, if you want the economy to be tightened, you will reduce the interest rates. So you will increase the interest rate, so that borrowing becomes a more expensive, so that people have less liquidity and economy slows down a bit. Now, currently we are in a neutral stance. We are analyzing where should we go because of the tariffs. So let's say what happens. But currently we are in a neutral stance. The monetary policy stance is neutral right now. So very recently, I think on 21st August, RBI came up with this proposal that whether I should follow core inflation or headline inflation as my inflationary target. As I said in earlier slides, that we are targeting an inflation of 4%. Now, this 4% is consumer price index. Now, what is CPI? What is WPI? What is headline inflation? So I'll give you an example. So imagine a basket of goods. Okay. So currently I'm talking about core, or let's say consumer price index. So what happens is you take a basket of goods, you put all the goods that you want to measure the price of, let's say housing, transportation, services, medical goods, electronics, food, as well as energy. You take the basket of goods, you compare these prices after, let's say, 5 years or 3 years, and you see how much the prices have risen. Now, currently, we are targeting consumer price index, and in consumer price index, you are including a lot of things. You are including food, energy, services, the price of services, medical, etc. You're including all of these things that consumers spend their money on. Now, the problem with targeting consumer price index is that you have included food and energy. This is the weightage of food and energy in the CPI basket, 45 and 6%. Now, the problem with food and energy is that they are very supply dependent, not as much as demand dependent. So let's say if there's any supply shock, let's say if we have a bad monsoon, what will happen to food prices? They will fluctuate a lot. They will increase a lot, right? Similarly, with energy, we import a lot of crude oil. Now, we import a lot from Russia or let's say Middle East. Now, if any disturbances happen in these countries, we will experience what we call a supply shock. And then the price of these commodities, it will fluctuate. Now, when this will fluctuate, again, the CPI as total will fluctuate. The headline inflation, which includes all of this, which we are currently targeting, it will also fluctuate. Now, monetary policy, what it does, it targets to achieve a certain inflation. Now, the thing that you are targeting, if it fluctuates a lot because of something that is happening outside your domain, you might be able, you might end up making policies, or you might end up making decisions which are not beneficial for the long term, because you are considering the short term impacts. So the counter argument to this is what people say is that you should target core inflation. So when you're targeting core inflation, you exclude food, you exclude energy. You are targeting on such products which have a direct relation with demand, not as much as with supply. So when you're targeting core inflation, you are making policies which are more long-term in nature, and they are not distorted by your supply shocks, which are outside your domain. Now, one thing that has to be considered is that most countries around the world, so around 48 countries around the world, which target some sort of inflationary target. Just one country, that is Uganda, only that country targets your core inflation. When you target core inflation, you're excluding food and energy. So why most central banks, they target headline inflation is because your target will be then more credible, because you are not giving when you are targeting core inflation, you are somewhat giving us a message that you are sitting in an ivory tower and making decisions which are oblivious to the general public, because you are excluding the price of food. Food is something which is very connected with the spending pattern of a consumer. So here you can see, so basically most reserve banks, most central banks, they target your headline inflation. Now here you can see the yellow line, that is the fuel, it is fluctuating a lot. Food, the gray line, it is also fluctuating a lot. Now, as compared to headline versus core, core is somewhat stable. You can see the orange line, it's somewhat stable. Headline is somewhat fluctuatory in nature as compared to core. So that is the debate going on. But let's see what happens, and what do we go with. My personal take is that we'll continue to go ahead with headline inflation because of the reasons that I mentioned. So till now, whatever I've talked about is basically a lever mechanism. So basically, you pull this lever, you reduce repo rate, you increase your liquidity, etc. You want to increase GDP growth, you do this, etc. I have painted a picture which is somewhat a straitjacket formula, but in real life, this does not happen. Why? Because you have multiple factors going around. So to give you an analogy, there's this three-body problem in physics. So there's this concept that if in celestial system you have one body and you have another body, and they are orbiting each other, it is easier to predict their path, because one's gravity will influence the others and vice versa. It's easier to predict their path. But as soon as you introduce a third body in this system, what will happen? There will be a somewhat chaos, because now body की जो gravitation है that is affecting someone else, and vice versa. You will not be able to predict a accurate path. There will be chaos. Now in economics, there are not just three bodies. There are multiple bodies. There are multiple factors. You want to achieve GDP growth. There are external factors. COVID came in. Then you have your tariffs. Ukraine-Russia war. So all of these factors combined with your the inflation you are targeting. So all of these, they affect each other and they influence each other. So this is one reason why monetary policy of the RBI, they meet every 2 months to discuss what is going on, and then it sets the your repo rate, which is the overnight rate. So briefly talking about case studies from around the globe, just to show ki GDP and inflation and interest, all of these are connected with each other. So so Japan is a very large economy. It's the fifth largest economy. However, it's not growing as much. So here you can see the GDP growth rate of Japan. It's 0 to 2%. Now, similarly, if people are not spending a lot, country is not growing as much. Naturally, the inflation will be very low. So most of the time, it's less than 1%. Now, as a result, the interest rates are also very low. The the interest rates are so low. At one point, it went negative. So you were also facing negative interest rates in Japan. That's how keen the government in Japan is to make its citizens borrow money and spend money. Because if they'll spend money, there'll be demand, and the GDP might increase. On the other hand, Mexico in the 1980s, right now the inflation is controlled, but in the 80s, what happened? There was a spike in inflation, and as a result, you saw a spike in the bank deposit rates as well, because the central bank rate also went up to control the inflation. Now, Argentina right now, it is fighting with inflation. As you can see, the short-term rates are increasing as well as the inflation is in tandem with the inflation. So just to show you, there is a connection between all of this. So in India as well, you can see right after COVID, to grease up the economy, we reduced the repo rate, and you saw a reduction in the lending rates as well. You saw surplus liquidity, and as a result, there was too much heat in the economy, and you saw inflation. It reached as far as 8%. So this discussion till now was regarding what RBI was doing. So RBI was controlling the money supply, it was controlling the interest rates, etc. Now coming to other end of the spectrum, what is the union government? That is, what is the fiscal policy tells us about. So government, it can control many things. Two of them are taxes and spending. So I'll be discussing very shortly on how government uses taxes, how government uses spending to influence the economy. So coming to fiscal policy. So before coming to fiscal policy, this is just a brief of where the government spends and where does it earns. So you can see 20% of our spending is just on interest payments on earlier loans. Similarly, 24% of our revenue is coming from borrowing and liability. So we are basically borrowing a lot to pay a lot. And most of our borrowings are going into just to repay our earlier loans. Now, coming to budget. Budget is the primary tool for fiscal policy. It controls how the government will spend and in what sectors it will spend and how much it will spend. So to understand the government's budget, a good analogy will be to suppose how do we as individuals, how do we make budget? So first we know our income. Let's say we know our salary, or let's say we know our income. And then we plot our expenses. We say, okay, this much we'll spend on rent if you're living in a rented house. This much we'll spend on food. This much on groceries, etc. First, you do your incomes, and then you see your expenses. And then, if you have certain, let's say, amount left, that will be your savings. Government, on the other hand, what government does is government first sees how much it wants to spend, how much is the need of the economy, how much people are required to be spent on. So first it sees how much I have to spend in what sectors. Let's say government identifies I have to spend this much on infrastructure, this much on subsidies, I have to spend this much on, let's say, Pradhan Mantri Awas Yojana. So first it sees how much I have to spend, and then it sees, okay, how from where I will earn. I will earn this much from tax, this much from dividends, this much from sale of, let's say, stake in government companies, that is disinvestment, this much from tickets, etc. So then you see your incomes. This is in contrast with how individuals make their budget. Now, For a government, since you have plotted your expenses before your incomes, there is a high probability that you will get certain deficit. Your expenses will be more than your incomes. So this deficit portion, we call this total fiscal deficit. In this example, you can see your total expenses, they are 50, your total income is also 50, but out the out of 16 rupees of income, 15 rupees is the deficit. The 15 rupees is the debt that you will have to incur. So this 15 rupees on an overall basis, we call this your total fiscal deficit. Now, as I said in the earlier slide, 20% is just be going to your earlier interest payments. Now, out of this 15, you decide, you आप देखते हो कि इस 15 में से how much you are going to pay just for your interest on earlier loans. Okay, so this portion, this interest payments, out of the 15 rupees that you are borrowing, how much are you paying just on your interest on earlier loans? So you reduce that amount. In this example, 12 rupees. So 15 minus 12, you get 3 rupees. 3 rupees is the total primary deficit. So primary deficit is another way of telling how much is the government borrowing this year to spend in the economy, because the 12 rupees that you are not spending on the economy, you are spending just on earlier interest payments. So this is the concept of primary deficit and fiscal deficit. Now this is the deficit trends. Right after COVID, you saw a lot of deficit. Why? Because the government was borrowing a lot. Why? Because it wanted to spend a lot on the economy. Why? Because it wanted to grease up the economy. It wanted it to function smoothly, or let's say it wanted the grease to be there. Now, after COVID, you saw there was a decline. We also call it as fiscal decline, because now the government is consolidating its borrowings and it wants the deficit to not be a lot of percentage as compared to its GDP. So these figures, they are as compared to GDP. Now there are other concepts as well, like revenue deficit and effective revenue deficit. Basically, they tell you how much where the borrowings are being used. So not going into much detail on these concepts. The main ones are fiscal and primary. So if you see in the budget, the deficits are going up. It means the government is in a position, is desirous of spending a lot on the economy. It can sometimes be matched with the reduction in repo rate as well. Because again, government, it cannot happen. Government is spending a lot and the RBI is increasing repo rates, because that will be contradictory in nature. Coming to the last part of this presentation, so GDP and its type. The most important things is nominal and real GDP. So whenever you see the word real, it means that you are disallowing or you are taking away the effect of inflation. So you have in real interest rates and you have real GDP. So real interest rate is when you are depositing your money in a bank and it's giving you 10% returns, but the inflation is, let's say, 11%. So your real income is negative. You're losing out money. Now, applying this concept in GDP. So what is GDP? GDP is the aggregate value of all the finished goods produced by a country, goods and services produced by a country in a year. Now, quickly to understand this distinction between real and real and nominal. So let's say then you produce 10 units of 5 rupees each. Your GDP, it becomes rupees 50. That's for year one. Now, on year two, on the next year, what you did, you again produced 10 units only, but the price due to inflation has increased. So earlier the price was 5 rupees, now it's 6 rupees. What happened to GDP? 10 times 6 is 16. The GDP has magically increased. But the question you have to ask yourself is, did my production increased? The answer is no. Your production remained same, that is 10 rupees. The increase in GDP was just due to inflationary factors. Now, you use the concept of GDP deflator. It is different from CPI and WPI. Basically, what you do in GDP deflator is you put the prices of year one in the numerator and prices of year two in the denominator, and then you multiply it with your nominal GDP of this year. So you multiply it, and then you will get your real GDP, which will come at rupees 50. Now you can see nominal GDP to real GDP, it remained the same over the year. So it shows that there is no real increase in your GDP. So whenever you are seeing the GDP numbers, ensure to look at the real GDP as well, because that will show how much your country has grown, and it will disregard the effect of any inflation. So these were some of the things regarding macroeconomics, how they affect. Thank you so much. Let's see you all in another session.